Good morning, friends, and a very warm welcome to our webinar for bankers. Understanding and mastering NPA management is not just a regulatory necessity.
About 10.4 lakh crores for the gross NPAs of the scheduled commercial banks. There was a drastic reduction of both gross NPAs, net NPAs of scheduled commercial banks, and also the in public sector banks. And net NPAs have come down from, and in respect of public sector banks, it is increased from 46% to 93 plus percent. At the guidance of the Government of India and Reserve Bank of India. So NPA management is always very, very important for banks to show a better performance in different KPIs. So provisioning, there is a provisioning for not only NPA accounts, it's also for standard assets. For farm credit and MSC, it is 0.25% and others 0.4%, or wherever it is observed, there is a evergreening of the accounts. Recently, in case of standard assets, important for reasons from the banking side, though the other reasons are there which have accounted for which will affect the bank's profitability, decrease in the reserves and surpluses, ultimately affects the net worth, ROA and ROE adversely, because once the accounts become NPA, the risk weight will increase depending upon the provisioning. Shareholders' confidence and value creation will be affected adversely. So 100 rupees NPA is causing the negative impact on bank's profit and loss account and balance sheet, which are the sources of finance, and 3% will be available as an interest fed. So totally 3 plus 7, 10% is lost, and opportunity cost of return on capital, because risk weight will be increased. So higher capital to be maintained and opportunity cost total put together about 26.6%. Plus, likewise, second year it will go to 29.9, 20.9, third year 25.7, fourth year there will not be any additional provisioning, 10.7, and last fifth year additional provisioning of 60% to make it 100%. So 70% is the total cost of holding, major impact of a financial impact on the balance sheets. So containing the slippage of NPS, CIBIL and other credit information bureau information, verification of defaulters list, verification of willful defaulters, suit filed accounts at the strong sanction stage, timely sanction, documentation, perfection of security, or does not comply with the terms and conditions of agreement within stipulated time, has also siphoned off the funds. Means funds have been taken away from the unit, and a final decision to be taken whether to declare as a fraudulent account or not within 6 months with it, to the banks except DRTs. Then you are all aware civil suits and interim reliefs, like we have to claim in the plaint, particularly very, very important by the part defendants. DRT direct the defendants to make the payment, such admitted amount within 30 days and issue the recovery certificate to this effect. And decree will be passed to the tribunal within 30 days of the date of order. They can appeal to appellant tribunal DRAT within 30 days from the date on which the copy of order received by him with a deposit of 50% of the debt, Financial Assets and Enforcement of Security Interest Act, which provides different options to banks and financial institutions for resolving their NPS. There are certain conditions. The borrower accounts must comply. The account should have become NPA. It must be duly and effectively charged to the bank and therefore enforceable if the borrower fails to pay in response to the notice. there will be agreement for liability whenever we'll give the loan. And whenever he defaults in repayment, default will happens, and ultimately and simultaneously filing with the chief judicial magistrate or district magistrate for giving the during the period of physical possession, we have to obtain the valuation reports from banks, a board's approved valuer, and reserve price of the asset must be finalized and publish a 30 days. Borrower is having a right to appeal to DRT within 45 days from the date of possession of secured asset. The DRT may declare actions taken by the secured creditor as invalid and restore the possession of assets to borrower. So once possession period 30 days notice is over, bank can go for auctions. Whatever is listed here, as discussed earlier, we have to plead in the interim application with the.
Thank you, sir. Thanks for giving me this opportunity of talking to the participants directly. Anniversary is approaching shortly because we started on 1st of April in 2017 with Bankers Weekly. So, like every year, we'll be announcing heavy anniversary discounts, videos, and of course, membership of this Elite Bankers Club, which is of interest to all the bankers. In the first week of this month, April, we had covered in this week's magazine, which is on banking, extending a bank financing of NBFCs. And this happens to be the last webinar during this year because now you will all become very busy in the annual. So it is something very important. We'll start with that. And by that time, I hope within 5-6 days, we'll be final with our webinar calendar also, which I'll be sharing with you. But at the same time, I request you all for renewing your membership of the club, but also share the details of our club with your colleagues so that our strength increases. And once our membership increases, we will be able to give more and more benefits to our members. So I request you all to let your colleagues know about our club, ask them to join, and
in the legal ecosystem in India. As I said, 4 hours followed by the government, NCLAT, which is the appellant authority, within 30 days. In case operational debt provider is called the operational creditor. So who can initiate the corporate insolvency resolution process? This we can treat it as a step 0. So step 0 is over. Now the application is filed with the adjudicating authority, say NCLT. So in the step 2, there are certain activities will be undertaken. They are called public announcement about the commencement of CARP must be done. Then he will ask for the submission of claims from the various creditors. He should obtain this and reporting the certifying the constitution of the COC. So COC, Committee of Creditors, adjudicating authority, and that adjudicating authority has to complete the approval within 10 days from the first COC meeting. That is X plus 40. So it ends with the appointment of the resolution process as we classified it as a step 2. But as per code, his appointment should be finalized within 40 days. So 40 plus 7, 47 days, the valuer has to be appointed. And the committee of creditor to dispose the application within 7 days of his receipt or 7 days of constitution of a. So, but this amendment has given withdrawal with for certain reasons only. That is full settlement with the applicant, full settlement with other creditors, agreement to settle in future, transactions, RP has to look into it and he should frame an opinion within 75 days from the commencement. That is X plus 75. And then after framing the opinion, he has to make a determination on these transactions within simultaneously. He may be preparing the information memorandum that has to be submitted to the committee of the creditors within 35 days of the commencement. These things are happening simultaneously. And publishing the Form G, that is within 60 days, the commencement, asking for the opportunity for submission of the objections by any resolution applicants to the provision list, so that X plus 90, the submission of objections should happen, and the final list of the resolution applicants by RP has to be completed 10 days from the receipt of objections, and it completes the 100 days. So X plus 90, receipt of the resolution plan, it will be received by it. It takes that plan has to be given within 30 days. List within 30 days, they have to give that plan. So once X plus 120 days, verification of resolution plan, the RP will take 10 days, X plus 130 days. So it submits the resolution plan to the committee of the creditors by the before 130 days. So this makes the completion of the not approved, goes to the application to the NCLT. NCLT will rejects, and it goes to the liquidation. Suppose it approves with 66% of the value, it ends the step 4. Once it is approved, it is a stage 4, that approval has to be given within 30 days from the date of 160 days. They will approve and they will submit. The approval of the resolution plan should be completed by the NCLT within first insolvency resolution and liquidation cost will be met, or IBC in respect of this. Maximum period is 330 days with one extension of 90 days, and any other legal hurdles and all are there. It has to be completed within 30 days. When we are talking about the pre-packaging resolution, we compare this and the pre-package so that you will come to know the salient features of both the to expedite their process. So pre-packaged insolvency resolution process was introduced. A restructuring plan which is agreed by the corporate debtor and its creditor prior to involving insolvency filing, and then sanctioned by the adjudicator in a expedited manner. So it is a restructured plan already agreed by the borrower and the bank, sanctioned by the adjudicating authority. That means it is a restructuring plan agreed between the borrower and the lender, and a stamp of sanction will come from the adjudicating authority. So it will be in case of SARP, it can be initiated by the financial creditor, corporate debtor, or the operational creditor, whereas the prepackaged insolvency resolution process can be initiated by corporate debtor only. The work of the role of the resolution professional begins in case of SARP after filing, here before filing itself. If the process of resolution fails in the SARP, it goes to the liquidation. It is finalized and submitted to the adjudicating authority. Once it is sanctioned, it is binding, and it will start the structure of formal insolvency proceedings. So, and the updated list of claims will be prepared, and base resolution plan also will be prepared and discussed with the lender, and it will be adjudicating authority. Then the commencement of the resolution process happens. Within 7 days, the resolution professional has to constitute the committee of the creditors. The committee can accept or reject the basic resolution plan depending upon their liabilities and all. Suppose basic resolution plan impairs the operational creditors. It is not taking the interest of the operational creditors. it has to be rejected. What I can say, agreeable to the lenders, committee of the creditors, it will accept, that is COC may approve the BRP, and it goes the plan will be submitted to the adjudicating authority within 90 days, and it will be approved. If it is approved by them, the pre-pack closes with the resolution. If adjudicating authority does not approve, it will go for publication of invitation of resolution plan. So the resolution professional will go for an invitation of resolution plans from outsiders. If no plan is received, COC may approve the basic resolution plan submitted by the corporate debtor with the objective of debt transfer, so that aggregation of such stressed assets will happen, so that the coordination problems between among the different banks will be solved. The decision making will be faster. The bad bank was established, and it is also possible to take full advantage of the RBC specific sectors, protecting the quality of other assets. Fear of 3Cs can be avoided. Improvement of the equity evaluation of banks, bad bank stage itself. Then full advantage of the IBC can be taken, because the banks, when they are proceeding individually in the consortium, the committee of the creditors are not able to take full advantage of the IBC, because they are taking a lot of time for concessions, CVC, CBI, and CHG. So the bankers are afraid of taking decisions, because if bad bank is formed and the asset is transferred, the decision makers and sanctioning authorities are different. So this can be overcome. Then improvement of equity valuation of banks, when these assets are transferred to the bad bank, the bank's balance sheets will be cleaned, and it's a it's cleaned, and the balance sheet strength will be improved, market share values will be improved, so equity valuations will be improved, and banks also can of the prospective borrower. It appears to be very basic, and we learn whenever we learn 3Cs of the credit in the fundamentally when we start the credit, very basically. But even today, it is very, very important. When we have seen the big accounts have become NPA, for the big accounts becoming NPA, besides other reasons, some of the accounts, borrowers have not brought their margins. They have not infused their margins, or they have infused less margins by inflating the projects. So ensuring the capital ability, infusing ability of the prospective borrower. This is the important things. Then regulator need to identify excessives in the lending, including credit concentrations, in time, and intervene the moderate lending and exorbitant times. This is important. See, the a regulator, Reserve Bank of India, when banks are in a herd mentality, are going for the particular infrastructure or steel industry or some other industry, when they are going, the regulator should focus. Now everybody is doing the retail. Then everybody will start project financing. So there is a concentration risk. So a regulator should monitor very periodically, regularly, and should fix the maximum exposure limit to the particular category of a particular sector of the economic activity, and also the maximum exposure limit to the groups and individuals. No doubt, Reserve Bank of India is having the exposure limits to the individuals and groups bank-wise, but banking system-wise, it is not there. Though it said with a market exposure mechanism, though it said that the about 10,000 crores enjoying borrower who is a specified borrower should raise the incremental funds to the extent of 50% from market. But there is no maximum exposure limit from the banking industry to the borrower. Such exposure limit should be there. Big loans or medium loans, the banks are not having proper monitoring of the loans. That threshold of 250 crores, banks can think of to reduce to 100 crores. Then early warning signals framework has to be observed very well, so that it gives a lot of information and alerts, so that red flagging or other things can be observed and proper steps can be taken. Declaration of the accounts as non-cooperative borrower, willful defaulters and red flagging can be done. This formation of bad banks, this have to be utilized. Insolvency and bankruptcy code, it is, though it has to be completed within 330 days, it is taking more than practical level. So the time gap between the initiatives and their implementation should be shortened, and it may consider exchange of its officials with commercial banks in the implementation. Strategic risk and the restrain the exuberance. As I said, when the economy is doing well, the bank managements may deploy the credit to certain sectors at an accelerated rate. So board should observe and take care. And also the board should observe, play an important role in mitigating steps in this regard, and open the NAPFID for financing the infrastructure. Further, the developmental financial institutions should be established, so that they will get expertise in the pricing the project loans, so that the banks can also participate in the.
One is that banking is a lifeline of economy and lending is our dharma. When you say connect the dots, what is the life cycle of a borrower? It starts from procurement, manufacturing, supply, sales, receivables, and thus everybody who is engaged in the cycle, I think we must do due diligence on that, and it's not very difficult in today's time with the kind of information which is available. We have seen in 2008-9, we were at 2% GNPA, we went up to 14%, we have come back to again 2%. And now it is the responsibility of your generation of bankers to see that this 2% GNPA is retained on a long-term basis. Thank you very much. All the very best.
And insolvency bankruptcy code, the regulator is also somebody else, and risk-based supervision. If commercial banks are taking risk without mitigation, probably supervisor will say provide more capital, provide more provision. These kind of things are coming. When it comes to individual lending, so commercial banks should be more careful in a deregulated environment to manage their credit portfolio. So Reserve Bank is taking a view that probably growth does not support this kind of credit growth. And therefore, where it is unsecured loan, they wanted to control. Very recently, government, means a few years back, government has come out with what is called the NAPFID, National Bank for Infrastructure Development. This, term lending institutions in India experiment did not work. That's why universal bank and commercial banks probably have to lend for the infrastructure also. Now, particularly when we are having what is called private-public partnership, the credit growth going to the MSME or industries or priority sector. And one more thing, actually, I should tell, even now there is a lot of confusion about in the IBC, that is creditor in control. In case of pre-packaged resolution mechanism, debtor in control. When you are forcing the commercial bank to go for restructuring and help this MSME. Is it not?
Thank you, Mr. Shukla, for that very nice question that you asked. And any other questions? And in fact, Farid sir has covered in today's session uh, 4 topics, which are NARCL, again a separate topic, and of course NPA management was always there. So Farid sir has in a short time covered so many things in his presentation, and I'm really thankful to him for that. There is no forthcoming webinar immediately. I'll have some time, and I'll spend that time in clearing up the backlog, and by the end of this week